Okay, so we're going to start with the multiple choice problems like we always do. We have 10 of them. Some of them we're going to go through a little bit with more detail, some of them less detail. So we're looking at question number 1 here. It's saying, what's the present value factor? So what they're saying is, use the table for an annuity, annuity of 5 periods with an interest rate of 10%. So we know when we're looking at this that it's an annuity, and we know that that's a series of a stream of payments for the same amount. We know that the case here, the number of periods, 5 periods, and we know the interest rate is 10%. So we would go, and I'm going to have to back out of the PowerPoint there for a second. When you're doing the homework, you can either, these present value tables and the future value tables, they're in the PowerPoint, but they're also in the book itself. So whatever is easier for you to access them, it does only go up to 10 periods in there. So in this case, so they want the present value factor of an annuity for 5 periods. So let's look here. We have the present value of $1, a present value of $1. So when we look at these ones are $1. Then we have the present value of an annuity, the present value of an annuity. And let's check out the facts here. So it looks like N is 5, I equals 10. So in this case, N is 5. Let's find it here. Equals 5. %. Gotcha. Yep, give me a second here. My eyes are shot from this. 1C. So the present value factor of an annuity of 5 periods with an interest rate of 10%. So interest rate, 10%. Okay, here we go. Interest rate was 10. We know we're dealing with the present value of an annuity, right? Our interest rate is 10%, and we're dealing with it for the number of periods, 5. So that would be 3.79. So we look back, there we go, C, 3.79. Now these other answers, and how I could trick you on the exam is, if you don't know which right table to use, and you just use N is 5, I is 10, or whatever the case is, I could put as another answer what that would show up on a different table. So you may think you got it because you see it, but if you're using the wrong table, it won't be right. Now we knew here this was pretty straightforward, right? They specifically told us present value of an annuity. So we know that that would be the table we're using. Number 2, we're going to skip just because it's not on the homeworks and the amount of time it would take. It's just more efficient to move on. So number 3, it says, which of the following best describes accrued liabilities, right? So if we go back to the PowerPoint, because I believe we're in the more of the front of them. Accrued liabilities. These are expenses incurred, so they're accrued in one period, but paid in a later period. So you have recognition before you have cash. So we have here as an example of an accrued liability, right? We know it's recognition first, and then cash second. So what does that mean? Recognition means you debit expense or you credit revenue first, and later on you pay the cash. right? So it would be like debit tax expense, credit taxes payable. So that was the recognition. Later on, when we pay those taxes payable, so we've accrued them, but now we got to pay them, we would debit taxes payable, so flip that out and credit cash. So given that that's the setup, the best answer for this one, long-term liabilities, current amounts owed, current liabilities to be recognized as revenue. This right here, D, is the best answer. Why? It says accrued liabilities are current amounts owed, so taxes payable, but not yet paid. We haven't paid them yet to various parties at the end of the period. That's why it's going to be D. At the end of the period, we would make this AJE, adjusting journal entry, to accrue our liabilities. Number 4 here. Looks like Big Fish Company has borrowed $100,000 from the bank to be repaid over the next 5 years. Okay, so looks like they borrowed $100,000. It's repaid over 5 years. Payments begin next month. Which of the following best describes the presentation of this debt on the balance sheet as of today? Well, could it be $100,000 in long-term liability? Maybe. But it does say here which of the following best describes. $100,000 plus the interest? No. You see here 4. A portion, looks like it's going to be C here. And we talked about this. A portion of the $100,000 will be in the current liability section, and the remainder will be in the long-term liability section. We talked about this in the PowerPoint where we said, hey, if you owe something over multiple years, you're going to put what you owe in the current year as a current liability. So what we're talking about in that problem is the current portion of long-term debt. So what's going on here is, we borrowed long-term debt, but some of it's due in the current year. So we kind of have to bifurcate it, break out what's due in the current year. Let's look at number 5 here. It says a company is facing a lawsuit. Uh-oh, we see the word lawsuit. We're probably talking about contingent liabilities, right? Looks like it's possible, but not probable, that the company will have to pay a settlement that management estimates to be $2 million. How would this be reported in the financial statements to be issued at the end of the current month? So we're dealing with a lawsuit, which we know is a contingent liability. The reason being, right, it's a liability contingent on a certain set of facts happening, like the lawsuit actually succeeds and goes through. And it looks like this lawsuit, given the particular facts, is possible, plus it's estimable, meaning they were able to estimate if it does come through, like if they are sued us and it's successful, it's going to cost us $2 million. So they want to know, how is this reported in the financial statements? Well, if we look at our little chart here, we know the only time that we report it on the balance sheet, right, is if it's probable and estimable. In this case, we said it's possible and it's estimable, right? Management said it's possible and it's estimable, meaning they said it will cost us $2 million if it goes through. For this reason, we're going to want to disclose it in the footnotes. So let's see here, 5, which one? That looks like it's going to be C, footnotes. Let's look at 6. which of the following transactions would usually cause account payable turnover to increase? So remember I said with the ratios, there's a couple of different ways I could test you, like what is the definition of the ratio, like the actual equation? What is the ratio trying to test or measure? And then I could ask you, like, how does the ratio increase or decrease? So we said the account payable turnover ratio equals our cost of goods sold over average accounts payable. And remember, we said with every equation, right? If the numerator goes up or the denominator goes down, the overall equation goes up. If either of the opposite occurs, that is to say, if the numerator goes down or the denominator goes up, then the overall equation goes down, the ratio. So with that in mind, they want to know which of the following scenarios will cause it to increase. So we're looking for one of these facts right here that will make either our cost of goods sold go up or our average account payable go down. Well, when we look at these facts here, what it's going to be is A, payment of cash to a supplier from a merchandiser previously purchased on credit. So what they're saying here is in A, what we're doing is we just paid an account payable off. We're reducing our accounts payable. We're paying off our credit card bill, right? That's kind of the equivalent of it. When we reduce our accounts payable, we increase the accounts payable turnover ratio. Seven, it says here, how is working capital calculated? So they're asking for working capital. And when we look at the answers here, well, we know working capital, right? Equals our current assets minus our current liabilities. That's going to be C right there for 7. Here's 8. So the present value of an annuity of $10,000 per year for 10 years, discounted at 8%, is what amount? Okay, so let's think about this here. They want to know the present value of an annuity, and it looks like $10,000, 10 years, 8%. So we got number of periods is 10 years. Looks like the interest rate here is 8%. And we're dealing with the present value of an annuity. So we're going to go to our tables. So we see present value, but that's of $1, present value of $1. Here we go, present value of an annuity. That's what we're looking for. And it looks like our N is 10 and our I is 8%. So 10 for N, I equals 8%. So it looks like we're using this 6.71 ratio, or not ratio, sorry, the present value factor. So what we're going to do here is we're going to say, okay, $10,000 times 6.71008, which we got from the table, equals 67,101. So that's going to be answer B. Nine here. Looks like a company borrowed $100,000 Okay, so borrowed at an 8% interest rate for 3 months. How much interest does the company owe at the end of the 3 months? Okay, so we looked at the interest equation, right? We said it was the principal times the interest rate times the number of months over 12 months. So in this case, it's going to be 100,000 that we borrowed times the 8% interest rate, and 3 months have passed over the 12 months. It's going to be $2,000. Finally here, we're going to do number 10. Fred received a gift from his grandmother of $100,000. Looks like she has promised to pay Fred the $100,000 in equal installments. Uh-oh, that's probably an annuity, right? It's an equal installment each year for the next 10 years. Fred wants to know how much the $100,000 is worth in today's dollars. Which of the following will Fred need to calculate this amount? Well, when we've done the other problems up here, essentially there's been 3 things that we've needed anytime we use the tables, right? You need the number of periods, you need the interest rate, which you use to get you the factor from the table. Then you can help use that factor to figure out what the value is. Well, in this case, for 10, looking at it here, we know the number of periods in this case is 10 years, but we can't get the factor until we have the interest rate. But we don't have the interest rate. So what this would mean is it's going to be D. So we would need the interest rate. Then once we got that, we would need the value from the present value table for annuities. So that was the multiple choice. Let's go through here and start looking at some problems. So these are going to be, like always, similar to the problems we do in the homework. So I'll read the facts here and then we can look at it. So it looks like a company completed the following transactions during year 1. Its fiscal year ends on December 31st. So basically it did the following things during the year, and it has a year end of 12/31, a calendar 1 year end. They want the journal entries for each one of these transactions. Also, they want the adjusting entries on 12/31. So journal entries, right? How we always do journal entries. We know our assets equal our liabilities plus our stockholders' equity. We know our debits are on our left, our credits are on our right. Debits on the left, credits on the right. We know assets increase with a debit, decrease with a credit, and we know the reverse is true for liabilities and stockholders' equity. Also, we know generally you're going to debit expense and you're going to credit revenue. If you remember that little chart, that will get you almost every journal entry you ever need to do from just a theory standpoint for do I debit this? Do I credit this? So we'll just work our way down through these. So it looks like January 15th, that's our first journal entry. We purchased and paid for merchandise. The invoice amount was $26,500. Assume a perpetual inventory system. And again, this is problem 4.1 in the book. So basically, we know here our first journal entry, we bought inventory, debit inventory, an asset which increased, $26,500. credit cash, 26.5. Our debits equal our credits. Next one here on 4.1. Borrowed $700,000 from the bank for general use. Signed a 10-month, 6% interest-bearing note. So we know that we got cash, right? Debit cash, 700,000. Credit note payable, 700,000. Because it's due in the next 10 months, it's going to be a short-term note payable, right? Remember we said the line of demarcation for long-term and short-term is 1 year. Next one here, it looks like June 14th. So 6/14. Received a $15,000 customer deposit for services to be performed in the future. So what happened here is, hey, somebody paid us before we did the work, right? We got cash before we earned it. So what that means is, sorry, I'm becoming the old professor, right? I got to sit in the chair. I can't stand for too long. This isn't looking good for my long term. I can't stand for one lecture, right? How am I going to make it till 80 doing this, right? I want to do this the rest of my life. How can I? We'll see. Maybe I got to just build up some stamina, right? So 6/14, looking at it. Remember, we got the money before we earned it. So we know that this is going to be, well, we got money, so debit cash, 15,000. Credit, you could do one of two things, deferred revenue, or what I would just put to make it easier is unearned revenue, 15. You could also see deferred revenue. So like I said, the journal entry they might use in the homework is deferred revenue. Then on July 15th, looks like we performed $37.50 of the services paid for on June 14th. So 7/15, right? Idea is customer prepays us, they give us cash, we then do some of the services they paid us for. Because that's the case, we're going to debit unearned revenue, right? Because it was unearned, 3.75, and then credit revenue, 3.75. Essentially, we went from, they gave it to us, we didn't earn it, so we teed up the unearned. Then, to the extent we earned it, 3,000 roughly, we earned it, we got to reverse it out. We've earned it. So reverse out the unearned and credit the earned revenue. Then it looks like the next one here, December 12th. We'll just move over here. December 12th. We received an electric bill for $27,860. We plan to pay the bill in early January, right? So we know this is an accrued expense. So we're going to debit utilities expense for $27,860. And then we're going to credit utilities payable for $27,860. We didn't actually pay cash for it, right? We just got the bill in the mail. But still, under the revenue recognition and the expense when they're incurred principles, we still have to accrue it. Finally here for 12/31, year end, they say to us, determined wages of $15,000 were earned but not yet paid. So this is basically just saying, hey, our employees, they worked for us, they earned some wages. We're going to pay them next year, but but we got to accrue it this year. So what we do is debit wage expense for 15,000, credit wages payable for 15,000. Just like how we teed it up over here, the unearned, and then it became earned, when we actually pay our utility bill and we pay our employees, you flip out the payable, right? You tee up the payable, and then when you pay it, you reverse it out. So that was one. Let's look at two here. It says prepare the adjusting entries for 12/31. Well, really here there's one, so for number two, there's one AJE we need to do. And it concerns this guy right here, the note payable, right? We took out a note payable that accrues interest, 6% interest. So what that means is we borrowed $700,000 times 6% interest. We borrowed it, it looks like on April 1st. So what that means is April, May, June, July, August, September, October, November. In this case, well, let me see here, 12. So April 1st, it's 12/31, so that's April, May, June, July, August, September, October, November, December. 9 months, right? You're allowed to bring your hands to the exam. 9 months have passed since we got the note, over 12 months. That equals $31,500. What that means is our AJE, it's the end of the year. Hey, we accrued our wages. We've accrued our utility expense. Now we got to accrue our interest for the year. So we would debit interest expense. 31.5, credit interest payable for 31.5. So that was problem 9.1. Let's look here at exercise 9.2. So it looks like they're giving us some information about payroll. They want us to provide the journal entry for March payroll, including employee deductions. They want us to provide the journal entry to include the employer's payroll taxes, and then they want us to do a combined journal entry to show the payment of the amount owed. So, as just an overview here, right? You have the business, right? That's who we're doing the financial statements for. They have employees. When the employee makes money, so let's just say, $100, they owe income taxes, FICA taxes on this amount. What happens is the employer takes right off from the top of their earnings their tax obligation. So they hold on to it, right? Here, we're sitting on the money. We withheld from your paycheck the taxes you owe. They then send that money to the IRS. And with regard to taxes, we talked about this, right? Sometimes the employee is totally on the hook for the taxes, right? If you make money, you're personally responsible for your income taxes, and you're on the hook for FICA, half of it. The employer, they also, every time you make money, they got to pay FICA, half of it. What's FICA, right? We said that's what funds Social Security and Medicare. So with that, let's do number one here, right? So the idea with this is, given these facts, right? we're going to start with salary and wages earned. Well, if we know that's the case, 200,000, we're going to debit compensation expense, 200,000. Likewise, we know that, hey, our employees made that much. They're going to owe the employee income taxes, 40,000. So what we do is, hey, we withhold that money. We're sitting on it right here. We withheld it from their paycheck. We're going to have a liability for income taxes withheld. $40,000. And the idea here is, hey, we're sitting on this money and we got to pay it to the government. If we don't pay it to the government, we're on the hook for it. So that's why it's a liability to us. Looks like another thing here, employee government insurance premiums paid. Looks like we have FICA taxes payable. So one of the things here, we're going to have a credit, a liability for insurance premiums withheld for 1,000. Same idea, right? We withheld some money from their pay. We got to send that into the health insurance company to pay for their health insurance coverage. We're on the hook for that. We got to send it in. It's a liability. Finally, looks like we have a credit here for FICA, the employee share. So the employee pays half and we pay half. Here we're dealing with the employee half. This is going to be 15,000. Finally here, to make this balance, right, we got 200 on the left. We got 55, 56 over here. We're going to credit cash as a plug for 144,000. So that's what actually goes out the door to the employees. They've earned 200. So, however, they're getting 144. The remaining difference are the taxes and their health insurance premiums that they owe, right? Just you can think about it. You don't get your whole paycheck, right? You earn 200, but you're only getting 144. All of the differences in between were your taxes that you owe. Two says, okay, well, we just dealt with the employee portion of it, right? We did down here that. Now they want to know, what's the journal entry for the employer? Well, the idea with this is we have debit compensation expense, and then we have credit FICA payable. But this is the employer share down here, right? So we took care, we withheld for what the employee owes. Now we owe money. So we owe 15. That'll be part of our compensation expense, right? Finally here, so what they want to do is, they're saying for 3, can you please make a combined journal entry to show the payment of all of the amount owed to government agencies? So essentially what they're saying here is, you're a business, you have an employee who's made money. You as the business have withheld some of that money and need to send it to the IRS. We just did the journal entries for what we withheld, for both what the employee's on the hook for and what we as the business are on the hook for. Now what we're doing is we're dealing with this part right here. We need to make the journal entry for when we pay the IRS. So we teed up all of these liabilities. Now essentially we're just going to reverse them all out. So what we teed up here and what we teed up down there, we reverse out. So we're going to debit liability for income taxes for the employee for 40,000. We're going to debit the liability for insurance premiums that we withheld from that journal entry for 1,000. We're going to debit FICA payable for the employee portion of 15,000. We're going to debit FICA payable for the employer portion, right? Because we teed up that FICA twice, once in journal entry 1 and once in journal entry 2, both for the same amount. Because we owe some and they owe some. Then we're going to credit cash for all of this amount, 71,000. So that's the journal entry, but if you think about it, employee made money, we withheld on that money. You don't get your whole paycheck, right? And then we send what we withheld to the IRS. So we sent 71,000 to the IRS. That's what we did. When we do that, we back out those liabilities we teed up. Let's look at exercise 4 here. 9.4. So this isn't too bad. Looks like a company borrowed some money, right? November 1st of this year. Oh, highlighter on the loose, right? They borrowed 4.8 million, the company. Looks like it signed a note that promised to repay the 4.8 million in 6 months. We got an interest rate of 8%. They want to know a couple things. Provide the journal entry to record the note on November 1st, so when we borrow it, do the adjusting entry for the end of the period, so 12/31. Do the journal entry to record the payment of the note on April 30th. And then 4 we won't worry about. We can talk about that afterwards. So what we're doing here is, looks like on November 1st, we borrowed 4.8 million. So we got cash, debit cash, 4.8 million. We got a note payable here, credit note payable, 4.8 million. Our debits equal our credits. That's great. We got journal entry 1, first requirement done. Now they want the adjusting journal entry on 12/31. So what that is 2 months later, right? We got November and we got December. 2 months have passed. What we're doing here is we're really, when they say adjusting journal entry, they want us to accrue interest. So what we do here is we take the 4.8 million we borrowed times the 8% interest rate, and we know 2 out of the 12 months have passed because it was November and December. That'll get us 64,000. So what that means is we have to accrue our interest for 2 months, debit interest expense, credit interest payable, 64,000. Got that from the calculation. Now they're saying, okay, you borrowed it in November, the end of the year happened. Can you show us on 4/30 of year 2, right, what the journal entry is at the maturity date? So there's 2 things we really have to do on 4/30 when we do this journal entry. We need to account for 4 more months of interest expense, and we also need to account for paying off the note payable. That's when it's due. We got to pay it off. So first off, let's take care of the first item here when we look at this. So we got 2 things. Interest expense, 128,000. So we got interest expense. We got a $4.8 million note times 0.08% interest rate. Well, we teed it up to the end of the year, so we're accounted for, we're accrued through November. Now we got to do it for the next 4 months, right? Because we got January, February, March, April. There we are. We're 4 months later. 4 over 12. That's going to give us 128,000. So what we do here is we'll debit interest expense for, let's see here, 128. But because we're paying all of this off, right? We're not really, I mean, we are accruing it, but we're paying it at the same time. Let's look at the other thing we need to do. We have to pay off the note payable. Well, we teed it up with a credit for 4.8. So what that means is we need to get rid of it through a debit, reverse it out. So 4.8 million. There we go. It was on there as a credit. Now we got it off by debiting it. Likewise, in this journal entry up here, we teed up a payable, 64,000. Now we're getting rid of it. We're going to debit interest payable for 64K. What all of this means is at the end of the day, you're going to pay cash of 4,992,000. So in other words, you borrowed 4.8 million. You have an 8% interest rate. When you pay it off under the terms and conditions of the note, you pay roughly 4,900,000. And really what that is a combination of what you borrowed, which was 4.8, plus the interest you paid, which was 192,000. How did we get that? 64 plus 128. So it's like pretty simple in the sense that you can just say, oh, okay, well, if I have an 8% interest rate, I know I pay $8,000 on 100,000. That's like the simple figuring out what the interest is. But actually doing the journal entries for it's a little bit more complicated because you got to see how many months passed. How do we accrue the interest for those months? Let's look at exercise 9.9. Actually, let's skip that because you guys can do that. That's a pretty simple one. That's a contingent liability. You could just compare the PowerPoint to the facts and figure out what the appropriate treatment is. But I do want to do 9.10 here because this would be confusing if we didn't do it in class. So they want to know, what is our working capital? We know our working capital equals our current assets minus our current liabilities. They give us these facts and they want us to know, solve for our working capital. Well, we have current assets, that's great. But what the heck, how are we supposed to find current liabilities in here? All we have are non-current liabilities. It's kind of weird, right? How do we get that? Well, what this presupposes is that you can back in to current liabilities. In other words, right, remember we know the fundamental equation, assets equal liabilities plus stockholders' equity. We know our total assets right here, our current plus our non-current assets equal 1.2 million. Those are taken care of. We know our stockholders' equity equals 380,000. With regard to liabilities, we know our non-current liabilities equal, let me see here, 400,000. What we're missing here is our current liabilities. So when you solve for X here, in this case, we're going to know that our current liabilities are 420. So in other words, 420 plus 400 plus 380 equals 1.2. So the idea when you look at this, don't freak out if you're not seeing current liabilities. You got to back into it. So once we solve for it, we know working capital is our current assets, 750, current assets, minus our current liabilities up here, 420. Equals 330 for working capital. This will be the last one we'll do, then we'll kind of wrap up the class. After that, just have some closing kind of comments. So, they want us to do here, what is the cost of the truck? They're giving us some facts, and then they're telling us what to do. So let's read A first. Bought a delivery truck. So on January 1st, the company completed the following transactions. Assume a 10% interest rate. So it looks like we bought a truck and agreed to pay $60,000 at the end of 3 years. So they want to know what is the cost of the truck that should be recorded at the time of purchase. So for one, what we're doing here is we know our N equals 3 years. We know our interest rate equals 10. And what we're going to do here is use the present value of a dollar table. So let's go to the present value of a dollar table, N3, I equals 10. So present value of a dollar, N, number of periods is 3, I equals 10. That looks like it's going to be 0.75131. 0.75131. So what we do here is we say, okay, $60,000, because that's what we agreed to pay, times the present value factor, 131, equals 45,079. So that was 1. 2, it says in B, which option for the office building results in the lowest present value? So essentially here for B, we rented an office building. We were given the option. We can pay $10,000 at the end of the year for the next 3 years, or $28,000. So we got 2 options, 28 or an annuity. Well, what we're going to do here is, and I'll just kind of quick hand it given the time we have, we're going to be using the present value of an annuity table. And in this case, given the facts, 3 years, so we know our N equals 3. We know our I from the facts up here are 10. When you go to the table, it's going to give you 2.48685. Multiply that times the $10,000 right there. That'll give you 24,869. So 24,869. The idea is it says which option results in the lowest present value. Well, 28 is pay it today. The present value of 28 is 28. The present value of the other is 24,000. So we're going to pick the lower of the two. It says in C, what single amount must be deposited in the account on January 1st of this year? So we look at it, it says establish a savings account. We deposited a single amount. It will increase to $90,000 at the end of 7 years. So what we're doing here for C is we're going to be using the present value of a dollar table, right? It was a single amount that's being deposited. Our number of periods is 7 years. Our interest rate equals 10%. When we use this table in these variables, we will have, you see here, it will be 0.51316. We then would multiply that. They want to know $90,000. That will give us 46,184. Finally, here for D, looks like decided to deposit single sum in the bank. It'll provide 10 equal annual year-end payments of $40,000. So we know that's an annuity, right? Equal payments and annuity. What single sum must be deposited in the bank of January 1st of this year? So for D, we know here, given the facts, 10 equal payments, so 10 years, N equals 10. In this case, I equals 10. We're going to be using the present value of an annuity table. So when we use these factors with this table, when we look that up, it's going to be 6.14457. We would then multiply that amount times, looks like $40,000. That would give us 245,783. So to the extent, like I said, you have questions on the homework, you can utilize this video.